Hong Kong, Tokyo and Sydney on something. So do need to use the microphone both for this room but also for our colleagues that have joined us on the internet or something. So welcome. We've sent a few notes around over the course of the last few days, and we've had a drink in Club 29 celebrating a fantastic year that was, and a fantastic 20 plus years of IFM. Today we want to spend some time looking at what the future looks like and share with you the plan that we've put to the board that is all but signed off. We have a board meeting again next week, and there's one element on the ISQ that we need their formal and final approval, but all the rest of the plans are otherwise discussed and agreed, and we thought today would be a good opportunity to share with you what we think the future might look like for this business, stepping off the wonderful base that you and we and all of your colleagues around the world have created. It is a business that is performing exceptionally well. I would go so far as to say it's one of the best performing funds managers, not just in Australia, but globally in terms of the investment returns and all of the other dimensions that we measure. This team, this business is doing a remarkable job for our investors and for our firm and for our shareholders, and hopefully it's an enjoyable place for all of you, for yourselves as well. So with that, as I said, we want to have a look at what we think the future might look like, and this comes as a result of a whole lot of consultation with our investors, with our shareholder advisory board, with our extended leadership team around the globe, clearly with our global leadership team, also of course with our board, and it's the culmination of many months of considerations, discussions as to what we think might be possible in order to continue to progress, as I said, the great momentum of this firm. So the first thing is that we have not changed our longer term aspiration. There is nothing new in this. We want to be the world's most trusted institutional funds manager, meeting or exceeding client objectives, a truly brilliant place to work on behalf of a global collective. I think I got that right without glancing at it. The couple of things that are important to stress, again, it has not changed. We do seek to be the world's most trusted institutional funds manager. Really important, not retail, not anything else. We don't want to be an advisor, we don't want to be an asset consultant. We just want to be a funds manager, and a funds manager for institutions that are aligned to our values and to our longer term time horizon. We don't just want to gather assets. Yes, we have grown the firm rapidly, but we do politely say no to those clients that in our view don't afford us the luxury to really invest for the long term and therefore generate the types of returns that we have historically been able to generate for them. So our aspiration remains unchanged, and we've got clear definitions, or relatively clear definitions, as to what success measures might look like to be the world's most trusted, etc., etc. But part of the measures are of course our goals that we set up on a per annum basis, which we believe will take us towards meeting that longer term aspiration. In terms of our overriding reason for being, lots of fund managers exist for lots of different reasons. They all say they're there for the investor until push comes to shove and the shareholder inevitably wins. In our case, we were set up by investors for investors. They are our shareholders, and they said as our shareholders they want us to focus on them as investors and their underlying beneficiaries, the people that are working really hard in Australia and increasingly around the world, working really hard to get to retirement and be able to afford a dignified one. That's why we're here. We want the world to, in essence, be a wealthier place. We want individuals that are working really hard through their working life to be able to get to retirement and afford a dignified one. And as a result of us investing money on behalf of those people, we also want to invest in communities, in assets, in enterprises that add to the societal good, that create jobs, that reduces emissions, that improves workplace safety. Yes, our overriding and primary fiduciary objective is to make sure that we optimise the returns for our investors. But in creating that shared prosperity, we want to not only create that prosperity as investors, but also make sure that the investments that we are making are doing good for society. Our view is if that happens, then we'll have a more prosperous society, and as a result you'll have more valuable enterprises, and as a result you'll have stronger investment returns, and as a result you'll have people getting to retirement and affording it. It's a very simple, virtuous circle. We are not here for our shareholders, although our shareholders have done remarkably well. We are here for our investors, and it's a wonderful case study of a business that actually is genuinely focused on its investors and honestly not prioritising shareholders when push comes to shove, and as a result of that making long-term business decisions, long-term investment decisions, and frankly building a really valuable business without focusing on building a really valuable business, just by being focused on creating that shared prosperity for our investors and for the communities and countries in which we invest, in both listed and unlisted markets. We never ever lose sight of that. We've had some wonderful things that we've achieved this year. I have personally done some remarkable things that I would never have dreamed of doing as a boy, meeting the Vice President of the United States, all that sort of stuff. But we get to do those things because a whole lot of working people in this country and increasingly around the globe entrust us with the responsibility of managing their money for them, and as a result, hopefully getting them to retirement and having them have a dignified one. It is something that we should never ever lose sight of, regardless of the exciting things that we might get up to individually or corporately as a firm. We are here for our investors, we were created by them, and we have an unrelenting focus on looking after them. The rest follows. In terms of our themes going forward, again, they remain unchanged. In essence, there are 2 consolidation themes and 2 growth themes. The consolidation themes: respect and retain our heritage. This is an increasing challenge for us, for our board, for our leadership team. We've gone from 100 people to 320 people in 7 years. We've gone from 2 or 3 offices to now 7 offices, and about to open an 8th office probably in South Korea in the not too distant future, I think. Yes, that's the plan. We've just been struggling trying to get somebody to help us do that, and hopefully that's getting close as well. But as we continue to grow, as we globalise, as we move into different cultures around the world, as we remunerate, it remains really important that first and foremost we respect and retain our heritage. Our ownership is a source of genuine, sustainable competitive advantage. For all of us that have studied, businesses just search for that source of genuine, sustainable competitive advantage, and we've got it. We've got a business that is owned by investors for investors. There is nobody like us anywhere else in the world, and it drives a unique culture, a unique motivation. We must always look to ensure that we are definitive about what that culture is, and we will continue to respect and retain it, because with that strength we'll have the capacity to continue to do some marvellous things around the world. The second consolidation theme is around strengthening the resilience of our business. We've focused a lot on asset management, particularly in our unlisted portfolios, but also across our listed portfolios, really strengthening the portfolios that we manage to make sure that they perform well but are also nicely buffeted to any risks that we might face, either anticipated or unanticipated. We've invested a lot in our client relationship management. We've invested a lot in our business to improve the resilience of our staff through a whole range of systems and support and development. We can never rest there, and we've obviously invested in strengthening the financial position of this business. We need to have the financial flexibility to invest strategically in the things that we think we need to do in the long term. So the resilience of this business has improved substantially over the course of the last few years, and it's been a key theme, and it will continue to be a key theme. Look after your portfolios, look after your people, look after your customers, and look after your P&L. Make sure you look after all the stuff that you've got, your people, your portfolios, your P&Ls, etc. Because if you do that, then it sets you up well for the future. Then the growth themes: selectively diversify, not just diversify. If people have money and they can fog up a piece of glass, I've said this before, we won't necessarily take it from them. We only compete in around about less than 50% of the Australian funds management marketplace. The self-managed super sector, the retail sector, they don't align to us. They don't necessarily afford us the luxury for investing in the long term. Yes, they've got money, but we just want to diversify, but selectively, and make sure that in continuing to grow our people, our clients, and our investment reach, that we are still very selective, we're very judicious, and we are as proud of what we don't do and who we say no to as we are in what we do and who we do bring on board and the investments that we do make. So we've got to continue to be selective in our diversification, not just diversifying for the sake of growth. And we do want to globalise. The world is a very big place, and scale we think is really important. It adds value to all of our investors. The more we can selectively globalise, the greater value we'll be able to bring to our existing shareholder investors here in Australia and to our other investors around the world. So we will globalise our investment reach, we'll globalise our offices, we'll globalise our client base, and that journey has continued and continued at quite a degree of pace. But the four themes are really important. We want to consolidate, look after what we've got, our culture, our people, etc. But we also want to continue to selectively globalise and grow this business. Because I frankly, and I've said this before, I think the world would be a better place if IFM managed more money for it. I think the world would be a better place if IFM managed more money for it. Now that could be seen to be a bit arrogant, but given what we do, given how well we do it, given the value we offer in doing it, and given the genuine alignment we bring, I think many investors would be better off, and communities and countries would be better off if we did more for it. So we will continue to make sure that we look after what we've got, but we will be unrelenting in our desire to add more value to the world. And that's some of the things that we now want to walk through in a little bit more detail. In terms of the trends that have sort of framed our thinking, then I'm going to ask the leadership team to walk through the specific initiatives that we've got. The themes that, there's lots of things going on around the world, but we've tried to distill it into a couple of key things that really have informed the strategy that you'll see in a minute. Low return environment, we're not seeing, yes, there are some increases in some parts of the world, but we don't anticipate that there will be a huge amount of that, and they won't be going up significantly. So most investors will face amongst, if not the lowest, amongst the lowest risk-free environments that they've seen for many years. Yes, it's changing a little bit, but we don't see that ticking up tremendously. So returns will be hard fought. Returns will be really hard fought when your base rates are as low as they've been in the case of the Bank of England for 325 years, as an example. So there'll be a whole range of challenges in that for investors. Perhaps they'll need to lower expectations. Some of them are even lowering their own return expectations. Look at what Future Fund did here a couple of months ago, for example. Our clients around the world are increasingly lowering their return expectations. But I think clients in this low return environment will look for three things. They'll look for skill. Is the manager skilled? Is it experienced? Has it learnt from its mistakes? Has it continued to adapt and evolve its processes? Does it have a really skilled group of people? They'll look for value. How much is the manager taking of this profit pool versus going through to the underlying investors? And we've got managers in this country that are 4 or 5 times the size of us and 60 times our profitability. Who's making the money? The investors or the shareholders? So clients will be looking for skill, they'll be looking for value, but they'll also be looking for alignment. There's a lot of really smart people in funds management around the world, but some of those people don't necessarily ensure that their smarts are going through the investors' returns rather than the account of the fund manager. And Aidan sees that in the MSCI. In the MSCI. Fund managers in this country should be outperforming the MSCI by 25 to 40 points. And many fund managers are charging a performance fee for a tax arbitrage that they should just get by turning up for work each day, every day. So clients will be looking in this low return environment for skill, for value and alignment. Many managers bring skill but not value. Many managers bring skill and not alignment. Some managers bring value but no skill. I think IFM brings skill, value and alignment. And I think it's going to be really keenly sought in a low interest rate environment. And a low interest rate environment that's also got all the political uncertainty and North Korea and all those sorts of things going on around the world. Investors will fight really hard for every single basis point of return. So they'll look very closely at the skill, the value and the alignment of the managers that may or may not bring those returns. ESG continues to be a really significant part. It's always been quite significant in Australia, been very significant in Europe, but it's an increasing area of focus in the United States, and you never rest regardless of the strength that you might have in that area. In a low return environment, there's a lot of money chasing a lot of assets, particularly in unlisted markets. We will continue to be very disciplined, very patient, very thorough, very analytical, and we will say no if they don't stack up on valuation grounds. In this return environment, there will continue to be a role clearly for active, but increasingly smart beta is an area that investors are looking for, a more efficient and more predictable and more quantifiable form of extracting value, particularly in listed markets. Insourcing will continue to gather interest, but why wouldn't IFM look to be the outsourced insourcer? I think insourcing presents an opportunity for us, not a risk. If you're a high-cost, underperforming manager with misalignment to your investors, look out. You will get insourced, or you'll become the victim of insourcing. But if you're a manager like IFM, why couldn't we set ourselves up to be the outsourced insourcer, for example? So it is an issue, but I think it's an opportunity. Culture remains important in every business, particularly in financial services. Read all the stuff that's going on in Australian banking at the moment and the suggestions about that being a cultural issue, not just an operational issue. We must continue to focus on culture and be proud of and continue to distinguish our culture, as that's one of the sustainable sources of difference for the future. But net, there's lots of things going on, lots of things that worry us. Few people don't sleep as well at night as they might like to. But net, this business, the primary risk that we face is prioritising the opportunities that are ahead of us, as well as continuing to manage the risks that are clearly potentially in front of us. It's a nice place to be. We're not complacent about the things that could go wrong, internally or externally. We think we've got those things well covered. However, a lot of the risks that we face is determining where and how to play, and making sure that we put the resources in place to ensure that we realise the opportunities that are in front of us. So, the scorecard going ahead. First thing is, the construct of it remains unchanged. The 5 goals remain unchanged. They are the 5 goals. There's not a 6th goal or whatever else. The second thing is that the weighting to each of the 5 goals also remains unchanged. And that is, first and foremost, product performance is 55% of the scorecard. Investor satisfaction is 10% of the scorecard, so 65% is directly our investors. Then you might sort of say net funds flow is part of that, or it's an outworking of that. That's also 10%. Financial margin, we want to continue to ensure that we have that financial strength, so financial margin is 15%, and employee engagement also remains at 10%. So they're the first 2 points. The 5 goals that we've had for the last few years remain the 5 goals. Clearly the metrics change. The weightings remain the same as they have been for the last few years. This scorecard has served us well. It has served our investors well, it's served our firm well. We didn't feel a compelling need to change it just for the sake of change, particularly when we looked at the environment and so on and so forth. The specific goals are outlined there. Just a couple of things to comment on. These have all been thoroughly assessed, arithmetically assessed to the extent that we can, particularly on things like product performance, where we look at the 4-year rolling returns of each of the products and mandates. We look at the objective of those products and mandates, and we work out determine the likelihood of us outperforming on a rolling 5-year basis based on what we think we can and should do this year given the objectives of the fund and how much risk we do or don't want to take. And as a result of that, our MET objective is and stretch objectives are outlined there. Customer advocacy, we achieved 8.1 this year. That will be the stretch for next year. It'll be very hard to keep the 8.1, but we've said we should stretch ourselves to try and get there. But the MET target is slightly below what we achieved this year. That's not the right way to phrase it, Brett. But it's really hard. We're basically in the top, well and truly in the top decile of investor satisfaction. There's a high expectation that comes with that. So pedal as fast as you can, and your rating will probably come down. What it says is that we have to be, even more proactive in what we can do to better serve our clients, notwithstanding the strength of position that we're coming off. Our financial margin is 17.9%. Our net funds flows goes from a target this year of 7.9 up to 9.2. And that's been determined on a bottom-up basis per asset class, per geography, by the GRG team, with very little input from Brett for a change, which was... Boy, and the employee engagement, again, we achieved 79.1 this year. It will be a stretch to maintain that, but let's aim to get that stretch. Our MET target is 75 this year. All of those targets have been agreed with the board, except for the customer advocacy one, because we only got the ISQ results in a couple of weeks ago. We've just done the work on that, and we hope and believe that that's very well thought out and that our board will support that when we go to them next week. But apart from that, the other 4 goals, the construct of the scorecard, the weightings of the scorecard have been agreed by the board. The 4 specific threshold met and stretches for each of those 4 goals have been agreed by the board, and the ISQ will hopefully be agreed by the board when we meet with them next week. So I will shortly hand over to some people to walk through this, but there are, in terms of our strategic initiatives, it doesn't come out in this slide, but one thing I'd like to stress first and foremost is that whilst we have the longer term aspiration to be the world's most trusted institutional funds manager, and that means that we hope and believe that the business of IFM will look as it does in Australia around the world long term, a multi-asset class provider with a range of world-class aligned institutional clients. That's the long-term goal. But one of the things that we did realise and focus on this year is that the pace and path to that long-term aspiration will vary by region. So let's be realistic in setting ourselves up to achieve that long-term goal, but also distinguish the strategy to some extent in Australia versus outside of Australia. So in Australia, and indeed globally, the first thing, the priority, the number 1 is Project Greenwich. This business is growing and growing rapidly. We need to make sure that we continue to anticipate the impact of that growth and what it requires in terms of our strategy, our structure, our skills and our systems for our middle office and our back office. Let's make sure that in a multi-currency, multi-time zone, multi-mandate business that will continue to grow and flourish, that we have the operational strategy, structure, skills and systems to support that complexity, that diversity and that growth. So Greenwich is integral to that, and we're at the back end of the organisational design. I think the communication has been pretty robust through the organisation. Certainly the input has been very good, and I can't stress enough that this is a forward-looking, proactive look at what we need to do to make sure that the world-class front office capabilities are also supported by world-class, if you like, back and middle office capabilities. I don't particularly like those terms, but I think everybody gets them. Otherwise, around the globe, we will, in Australia, look to develop a collective core fund, and I've seen Aidan's presentation, so I won't steal any of his thunder, and I won't be able to because he's usually, he's at an innovative, creative best. But back to the earlier point, particularly in Australia first and foremost, and we'll look to do this over time, when clients are really looking to get fees down and returns up and retain their strategic asset allocation, they have an option. They can insource, they can put pressure on fund managers, or they could potentially look to a multi-asset class solution with IFM. So this is going to be our evolution. The asset consultant will still continue to play their role. The fund will continue to play their role. But why wouldn't IFM look to be the outsourced insourcer through something like the Collective Core Fund? I won't. So that's... Whereas around the world, we will, and it'll impact Australia as well, we will look to review and expand our infrastructure equity capabilities. Cole will talk to that in a minute. And we're also looking to extend our infrastructure debt capability, our credit capabilities in Australia to look, somewhat similar globally over time as well. Smart beta, as I said, is, a skill that we've got, but frankly, it's not something that's well known externally. Let's build up the renown of that and the support for that because it is world class. And let's, in so doing, make sure that we help our clients get their fees down and their returns up. And we will continue to aim to get to a genuine leadership position on ESG. And this is sort of probably not clearly put there, but enhance our reach is really continue to grow our distribution capability. Only with institutional long-term like-minded investors, but we're onto something here. We are onto something here. And clients, both existing and prospective around the world, are increasingly interested in talking to us more broadly. So let's look to continue to extend and expand our distribution reach and continue to expand our position in terms of ESG leadership. So with that, I'm going to ask the relevant leader or leaders to walk through some of the initiatives in a little more detail. And we do have questions and answers at the end, so we just wanted to try and keep to time. And I think I've sort of done that nearly to start. And I'll now hand over to both Philip and to Josh to walk through Project Greenwich.
Josh was standing at the doors. Can you just come in?
There are more.
Seats over there are more seats through the back in there.
So in the next 20 seconds, this is not going to end anytime soon, all right?
Okay. So Project Greenwich, one of the key strategic initiatives for FY18, and that's actually been kicked off through this last financial year. Why Project Greenwich? Really because the firm has been so successful and will continue to be so successful, we have an obligation to continue to review our operating efficiency, not just in Australia but globally. And when you saw the key strategic themes on the slide, two resonate particularly with Greenwich. One is the resilience of this business and how we continue to build the resiliency of this business. And the second is globalisation. We continue to globalise, and our operating support models for both the investment teams and for GRG need to be able to support a global presence. So Project Greenwich. We kicked this off late last year. We have had Deloitte's providing a facilitation role, excuse me, but it has been very much an engaged process with a very broad-based working group across IFM. It is all about focusing in on what we have to do as an organisation to be fully prepared for the continued growth and diversification of our business and the success of that business. It is a comprehensive review of our operating model. What comes out of Project Greenwich is a thing called a target operating model, and it looks at all of the operating support functions, all of the business needs from all of the asset classes, from all of the overseas offices, and then looks at how that might best be structured and where we should be looking at putting our investment into systems, peoples, processes and structures across the firm. Really, there's two key recommendations that are being put through to the final steering committee due on the 18th of August. And those really focus on a key aspect of our business, which is data. Increasingly, data internally and externally to our clients is just critical. How we organise it, how we maintain it, how we ensure the quality, integrity of it, how we actually flow it into client reporting and internal use. Unless we have very solid data structures and very clear governance over our data, it's very hard to actually be the most trusted institutional funds manager globally. And that's what this is all about, being the most trusted. So much of what we do in our support activities and how much we do in GRG and our investment teams across the globe is about building the trust with our clients that when we put a number to them, that number is right. First time, every time. And that's what the operating model is all about, ensuring we have the structures, people, processes and systems that deliver that every time. So data is a core theme, and the second is looking at where we actually do processes within IFM that may be more effective to be done by some other provider, an outsourced provider, but also to look at the markets in which that is most commoditized or most relevant. So in the US market, for example, there may be certain processes around debt or around listed equities when we finally move into a global presence for our trading, where that is better to be actually provided by a market participant outside of IFM. What would that do for IFM? It would enable IFM to focus in on the higher value support activities within the investment teams and the sales activities we undertake. So it's about making sure we're doing the right things with the right people and the right resources, not necessarily having to do everything ourselves. And that is part of the second focus. Where are we at? As I said, the final report goes to the steering committee next week, at which point we actually have a mandate that we can go back to the board with and say, this is the investment we need to make in the years to come around our operating support model, this target operating model. The first step, once we get that approval, is to form an implementation team. And the key focus initially from the high-level roadmap that we're seeing from the project is investing in this data management platform, both the data governance, the data ownership, ensuring the quality of that data, and making sure we've got a good system on which to build it, and then client reporting off that system. So that's one of the key first steps. The second part of the expected output is where do we need to invest in people and processes and structures to make sure we are organised globally to support the growth in this business. And that may well be around areas like data governance, where we actually do need to bring someone responsible and accountable for providing that service to IFM within our organisation. It may be in areas like project management and other areas which Greenwich will be looking at in terms of how we support the business going forward. That's really all there is. You'll hear more about Greenwich as the steering committee makes its final recommendations and as we put the recommendations to the board for where we want to invest in the future of IFM. Thank you.
Good morning, everyone. Chris Newton. I'd like to start just acknowledging traditional custodians of the land upon which we meet, the Wurundjeri people, the Kulin Nation, and pay our respects to their leaders past, present and future. I have get the pointer right, the enviable task of talking about ESG again for the second year in a row, and some people may question why it is now a continuing focus for the firm after 20 years of on-the-ground tangible activity. And primarily it's because, as Brett said, investors around the world are demanding, expecting more of all of their managers, including us, to tell them what we are doing to make sure that the environment, the communities in which we work, live and play and invest are healthy and sustainable and drive long-term returns. I'll go through a little bit of a look backwards, what we've achieved in the last year, what the focus is for next year, and also how we're going to start communicating more widely to a lot of our investors globally as well. I won't go through every point here, of course, there's a busy slide. One of the key things that came out last year, which you guys would all participated in and talked about, was the release of the Responsible Investment Charter. To give this context of just how important it is, healthy environment, strong and inclusive community, strong governance frameworks is what we believe, that the virtuous cycle that Brett was talking about with regards to long-term investments, we focus on those three, it will deliver a long-term sustainable investment returns. Interestingly, one of the largest, just to give you guys some feedback, largest investors in the world who do invest with us in one of our infrastructure funds commented to us that when they read our Responsible Investment Charter, they would like our principles on a T-shirt. Now, I sort of took that as a bit of a compliment. It's kind of weird as well at the same time. But, but the point is they're thinking about it, right? They're really genuinely concerned and they want that alignment with the way we're thinking, the way we're investing, the way we're acting. So just as an example. There's a few other things here that we have done. We've started to receive some external recognition. The Australian Human Rights Commission commended IFM's input into their report on how businesses can help with human rights and investments and so on, which is probably something we haven't sort of harped on about, but something that we should all feel proud about, how we were acknowledged by Gillian Triggs. It has actually resulted in some really positive outcomes with regards to our ratings globally. You'll see the Principles of Responsible Investment, which is the UN-backed peak body, have upgraded our scores across fixed income or debt and our overarching strategy and governance frameworks from an A to an A+. Again, something for us all to be proud of. The other one, which is the Responsible Investment Association of Australasia, I think that's RIA. It's also a record label, but anyway, that's another story. I've put us in one of the top Australian managers that truly integrates ESG into it. I mention these because this is not just about what I do day in, day out, it's about what each and every one of us, and this is one of the stories about being an integrated manager. Is really satisfying to see those results. For the coming year, again, won't go touch through all of these, one of the interesting things I point out, we'll continue with our diversity and a lot of linkages with the people and culture team, with our approach to diversity, both within our assets and investments, but also within our own workforce, climate change, human rights, and also a greater focus on measurement and trying to get this integrated reporting up and running. That's kind of like the golden goose when it comes to responsible investment. If you can get this right, a lot of people will follow. So if we can get it going, that'll be a great outcome. Just on the left-hand, that is left as I turn around, the corporate responsibility framework, we put that in, even though that's an internal thing. What we have noticed in the last 12 months is a lot of our investors are actually asking us about what do we do internally? What do we do for volunteering, giving, climate change, etc., as a business ourselves? And the US investors in particular ask us for data on our diversity, for example. Now we will get CBUS, Aussie Super, HESTA also now asking us as part of our RFPs to them, what do we do on corporate responsibility? So just a thing for everyone to be aware of. And I think I mentioned last year learning and development program. It is in the wings, just so you know. And then lastly, this is just really capturing this fact around the need and desire from our investors to know more. These are just a collection of ideas that we've started to work with GRG in terms of investment advisory committees. We have our first one for equities this Friday, and ESG will be a standing agenda item on there. If it's not, it will be. And bespoke roundtables, social media, etc. To give this context about, some of you obviously read these articles when they come out, but there's some challenges with the domestic supply chain for fruit pickers here in Australia, and there's some really bad stories about rather large companies, treating the migrant workers really poorly, poor working conditions, underpaid, no superannuation, which is actually bad for us as well. But some of the atrocities that are to happen inside Australia is quite alarming. When an article came out last week, I sent the email through to Woolworths, Wesfarmers or Coles and Metcash, and without fail, all three of them responded saying, oh, we expected IFM investors to raise this issue when we saw it in the press. So again, it's just another thing that's really important for us to remember. And a crying baby. I've had enough of those lately, I can tell you that much for sure. So that's probably a good way for me just to say thank you very much. There'll be a lot more coming up. Too many, I tell you. Twins. They're going to be the death of me. Thank you very much. I'll hand over to Ona. I won't click on to the next slide just yet because I've been told there's a secret surprise. No. No. Thanks very much, guys.
Good morning. Imagine an interactive town hall where you can ask questions as we progress through the presentation. Well, that's the innovation I'm bringing to you today. That's Ian's number. You can send your SMSs as we progress to Ian's number. We've hacked your number, Ian. That's what we've been doing over the last month. That's why the phones have been a bit unstable. Sorry, Ian. So, yep, our first message is coming through, Vinna. Oh, good. And I love you. But I am here to talk today about the Collective Core Fund. So before any of you text in, what is it? I'll address that one straight up. In essence, it's a balanced fund provided by IFM using IFM product that is consistent with the client's existing asset allocation. So the objective is, it's a solution for funds wishing to reduce their MER without the need to merge, by allocating a significant portion of their balance fund to the IFM Collective Core Fund. whilst retaining their control over asset allocation and manager selection by adjusting the non-collective core fund portion of their fund. I hope so, Gary, because it was your idea. Yeah, getting to that, Brett. So the imperative. The government and the Productivity Commission are focused on disrupting the existing default fund status. Large fund, economies of scale, and their ability to access illiquid asset classes is making small to medium funds uncompetitive. Costs of regulatory compliance are rising rapidly, and ASIC is moving to make total fees much more transparent. Small to medium funds can avoid mergers or takeovers by using the collective core fund. So IFM is providing a vehicle to small funds that allows them the same access to the efficiencies and the smart alpha that the large funds are already getting. Therefore, Brett, by providing a collective core fund, we're able to give the small funds members better member outcomes through lower MER and smart alpha ideas. Oh, stop, Brett. Kira, can you take Brett's phone off him? But I'll answer. So where are we at today? Well, we've got the formative thoughts. So I've given you the high-level ideas in the previous slides. We're currently engaging an external consultant to go through this idea, and within the next month or so, we should have an idea on whether we'll progress the idea or not. Yeah, Robin, yes. If you're looking to do this, Robin, you're welcome. But the reason it's landed in my lap is because to best meet clients' needs, IFM should have an investment solutions capability. We've already been doing this across parts of the business. However, they've tended to be within asset classes, and the scope now to do it across asset classes. For example, in my team, we've been doing Better Beta since 2012. And it was born out of responding to clients' needs and wants, creating something tailored. Oh, okay, Lawrence. Why don't you come up?
Hi. Well, I'm here to continue in that vein, talking about Smart Beta or Better Beta. We used to call it Better Beta, now we're calling it Smart Beta. The question is not, will it continue to grow and is it growing fast? The question is not, how fast is it growing? The important questions are, why is it growing so damn fast and what is IFM going to do to respond to that? So why it's growing fast is because it meets clients' needs. Clients in this low return environment and with a focus on costs want an investment process which is going to beat the market and which is going to be low cost and transparent. Also, it's the time for it now because of increasing computational power, increasing availability of data, increasing availability of algorithms. You put that together with the client needs and that's why it's growing so fast. So the only question is, how can IFM best respond?
So as I said before, we've actually been doing Better Beta since 2012. And here's a bit of a timeline of what we've been doing. So we always do bespoke solutions for clients. That's part of our point of differentiation and our competitive edge. But we've been doing it since 2012 when we developed for Hester a low CO2 portfolio. So the idea of that portfolio is to have a more efficient index portfolio that has companies that are more efficient in emitting CO2. In 2015, we had a good year. We started the Aussie Small Cap Smart Better Beta, and Vision Super started their low CO2 portfolio. In 2016, Lawrence and the team developed PRES, which is Pragmatic Reliable Earnings Strategy. That's the global better beta that we've been working on. And in 2017, you can see some more products there. The initiative is to continue doing this stuff.
Okay, so we're not going to define what smart beta is. We'd be more than happy to have another lunchtime session. If anybody wants, just send us an email and we'll organise one of those. But in a few words, what it is, it's a systematic, transparent way, and often intuitive, of getting better returns or risks for the clients. So in terms of where we are now, to understand where we can go with this, we have to understand where we are now. This is the spectrum of where we are. What we have is we have a couple of very, very good intuitive rationale for why things should work, and we've got some systematic mechanisms around those intuitions, those fundamental intuitions. And because we're client focused, what we do is we change those to fit the client needs. Some clients might need low tracking error, high tracking error, low carbon dioxide, tilt to ESG, whatever it is they need, we're here to meet the needs of the clients. And so that's the range that we're looking over right now.
So on this slide, we've got two portfolios that we manage today. The Aussie Super Small Cap Smart Beta Fund and the Vision Low Carbon. So Aussie Super, if we take that one first, getting access to the small cap space as an active portfolio, they've got issues. They're too big. You know, small cap managers are typically capacity constrained. If they want to get anything, any exposure into this space, they find it hard to find managers. So we created a better beta solution and gave them full capacity. They can get $1 billion exposure to this part of the market through IFM. That's our solution for them. Today it's a $450 million mandate and it is achieving alpha. Vision wanted an index-like fund, but they wanted it with a factor tilt to efficient carbon-emitting companies. Today it's a $900 million mandate with potential to manage a global low CO2 mandate.
So why do we think that IFM is a natural place for this? There's a lot of competitors out there. Because it flows from our DNA. It really, really does. If we look at some of our cultural foundations like prioritising investors, this is prioritising investors. It's giving them what they need in this current environment. We have to inspire innovation as well. We have to be able to build new things that match their evolving needs and that beat our competitors. And frankly, we have to achieve excellence because there's a lot of, Brett mentioned there's a lot of very smart people out there in funds management and there's a lot of smart people in smart beta. No pun intended. And so we've got to be at the top of our game. I'm not saying we can, but I'm saying I believe it's possible and we will do everything to achieve this. So how it works is we have to start with a very, very good understanding of smart beta. We have to understand our clients' needs. We also require, and this is very, very important, and one of the reasons that Aidan's team has been successful over so many years is we've always had infrastructure that allows innovation, allows us to trade in the ways that our clients need. We need to be able to respond quickly to what they need. And we prioritise investors, and that leads to IFM Smart Beta. So finally, where are we up to right now? Currently, we know that Smart Beta is growing in the market quickly. What we want to do is keep talking with clients, innovate to meet their needs. We've got to work with CBUS to get PRES core funded. We've got to complete the high conviction PRES, which will be small enough that IFM will be able to fund it, and also market the retirement product. We need that track record. We've already got a great track record. The Australian Small Caps one outperformed over the year to end of June of about 10%, give or take, with an information ratio above 2. That's just fantastic. But we need to grow from there. And the other thing is that this is just a very, very small part of a very, very large change happening all over society and in funds management. Society, you're hearing about algorithms, artificial intelligence, etc. It's growing. In funds management, investment solutions is going to be the next step forward.
So I think we've got one last SMS coming through. Yeah, they would say that.
Where's Brett?
Thanks so far, team. We also want to talk about the ISPT IFM joint venture in global property that we have established. So firstly, why, and then what, and then when. Why? This will be first and foremost for Australian clients, and then over time we'll look to take it globally as well. Australian clients in many asset classes, and property is no different, have got more cash than they have investment opportunities. And not many Australian clients have yet really substantially globalised their direct property portfolio. So as they continue to grow, there will clearly be a need for them to continue to globalise their allocation to international property. So given that, we've been sitting there for quite some years actually saying, should we, IFM, establish a global property capability to help clients access those markets? Because there are clearly a range of very skilled managers out there, but as I said earlier on, not all of them are skilled and offering value and offering alignment. So we thought there is something that IFM can and should do in order to support clients as they continue to globalise their portfolios, and in particular globalise their unlisted property portfolios. We looked at a range of ways in which we thought we could do it. Should we go and acquire another manager? Generally speaking, when you acquire another manager, you pay for FUM and you pay for people, and you generally get less FUM and less people than what you pay for. So acquisitions, in our view, are not, generally speaking, a great way to expand. Not out of the question, but not necessarily a great way. But we looked at that as an option. We looked at a team lift-out like we have done successfully in other parts of our business. We looked at doing it ourselves. And then we looked at a range of other options, and we also looked at the option of a joint venture with ISPT. We've got great unlisted expertise. We've got great global expertise. We understand regulations. We understand legislation. We have a fantastic global client base. We have reach with asset consultants globally. ISPT brings some complementary skills, particularly as a long-term, really strong performer in domestic property. So we've landed on the solution of a joint venture between ISPT and IFM for global property. This is not in the news, and I don't want to read about it in the news tomorrow, please. But we have established a joint venture company. The boards of IFM and ISPT have agreed. We've established a shareholder agreement. We've appointed a CEO. That CEO has come from ISPT, Tony McCormack. And the board is Gary Weaver and Carol from IFM, and two independent representatives from ISPT. No shareholder representatives on that board, consistent with the IFM model. And we're in the process of appointing an independent, hopefully world-class, high-quality, renowned property investor as the independent chair of that business. So that's the rationale as to why. A little bit about the what to date. Tony McCormack is establishing a small team that is working up the more specific product thesis, investment partnerships, co-investments, pooled funds. What's the risk-return parameters? What's the engagement with clients? We have been working with our shareholder advisory board, so that's the Australian Super, CBUS, HESTA, Hostplus, Vision, and also a representative from First. They've broadly endorsed this as being a good idea that IFM and ISPT should pursue. They haven't all dropped money on the table, but strategically they've said, yes, it makes sense for IFM and ISPT to look to access global property given the complementary skill sets we've got and given the needs that we have as funds as we continue to globalise our portfolios. So the next steps are that Tony and his team, in conjunction with us, if you like, across the board, are working through the more specific plans, the business plan and the product plan, if you like, and the marketing and the promotional plan. We expect that will be concluded sometime through September, maybe October, and then we'll look to go public on announcing this. But as I said, I prefer not to be reading about it in the Financial Review tomorrow, and I also don't want to be reading about any of our strategy in the Financial Review tomorrow, including the collective core fund, because I think, if that's not well understood, then people could misinterpret it, and that would be a great shame because I think it's a fantastic potential initiative. So all of the stuff we're sharing with you here today is FYI, and not for, I know you don't do this, but we don't want to read about it in the newspaper. So that's briefly the ISPT IFM Global Property Joint Venture in its early stages, but with more detail to come through September and October. But a board in place, a CEO in place, broad support from our shareholder advisory board and clearly an appetite from investors as they continue to globalise their portfolios in this country. Over time, we'll look to do what we've done in other asset classes, which is take the capability with a track record to non-Australian investors some years down the track. The long-term aspiration to be the world's most trusted institutional funds manager. So with that, I'll hand over to Kyle, who's going to talk about infrastructure debt. Is that right? Yeah.
Sure. Thanks, Brett. I'm presenting on reviewing and expanding infrastructure equity, and Josh Lim reminded me yesterday that I presented on this topic for every town hall meeting, so I'm pretty sure I'll present it next year as well. But let me update you on where we are now, and then effectively where we're going. Just to provide some context, in the year since the last town hall, the value of the assets in the international fund has grown by 23%. And that's in the context of an asset sale. So we sold our Duquesne asset in Pittsburgh, but we've still expanded the international fund by 23%. The value of the assets in the Australian fund has grown by 45% in 1 year. So in the year since we've gotten together, on a simple average basis, the two funds have grown by about 34%. And that's a really terrific expansion rate. I'm not sure it's one that we can continue, but it's still, I think, a really good story over the course of the year. And we've delivered the expansion by really a range of variables. The first is we've been able to deliver some new capacity. The second is we've acquired a one-of-a-kind asset. We've entered into a new region, and aspirationally and looking forward, we're seeking to open a new market. That first circle, which refers to delivering new capacity, the biggest transaction over the course of the last year was Osgrid. And this was only possible because of the asset management capability of Danny Ilya and his team. Let's be clear, we didn't invest in Osgrid, we took over Osgrid. We put our senior advisor in as CEO, we seconded 7 of our executives into the asset to build out the capability and change the processes. And we were entrusted to do that by the state of New South Wales and the federal government to effectively run the Sydney grid. This is an asset that's got a value in excess of $20 billion, and IFM took it over. This would not have been possible without that capability. Without that asset management capability, we wouldn't have felt comfortable doing it, and we certainly would not have been entrusted to do it by the two governments. Just as an aside, I should mention that Osgrid completed its inaugural private placement last week. So this was a takeout of a chunk of the acquisition debt. The total amount placed was $2.4 billion. That's the largest issuance in history by an Australian issuer into the U.S. private placement market. It's the largest issuance by any foreign investor, and it's the largest issuer by any utility in history, including the U.S. utilities. Turning to that second circle, in the European market, we acquired the M6 toll road. The M6 transaction is unusual for a whole range of reasons. The first is we acquired it from the banks. So we didn't acquire it from the previous owner. We actually acquired it essentially out of receivership. We bid cents on the dollar for the asset, which is pretty unusual, although not unheard of. It was the same way that we acquired the Indiana toll road. But the second thing that's unusual about it is it's a bypass road. So there's another freeway essentially that will get you to the same place without a toll, and it's really only used when that freeway is otherwise congested. So it's a much harder and more complex asset to understand. But what makes it really unusual is that it's the only toll road in England. There's one toll road in the country, and we own it. And getting comfortable with that asset was a function of a range of things. First of all, it was a function of our insight into the toll road asset class, but more importantly, it was a function of being able to be comfortable around the political overlay. No one likes paying tolls. It doesn't matter where you live, you don't like paying tolls. But you like it a lot less if there's only one toll road. And again, this is not an asset that we would have contemplated a few years ago, but given the connectivity that we've got, particularly in the UK and with regional governments, we were much more comfortable in acquiring this one-of-a-kind asset. That third circle refers to entering a new region. And we announced last week that we had acquired a 39% interest in the port of Mersin. This is a terrific asset on effectively every metric except for where it's located. It's got a US dollar revenue stream. It's operated by the Port of Singapore, which is one of the most efficient port operators in the globe. And it's also considered to be the best regional port by all of its customers. The challenge with this port is that it's in Turkey. And we spent an enormous amount of time really getting comfortable with the political metrics of Turkey, the fact that it was shifting in a pretty uncomfortable way. And we recognized that there were going to be some ESG considerations in this regard as well. There are many investors who would not go into this asset, and we had to be comfortable that there was the right balance of risk and return. What we did in this case, which is a bit different from what we've done in the past, is prior to making the final investment decision, we actually reached out and spoke to every member of our investment advisory committee. The IAC is composed of all of the major investors across the fund, and we spoke to them about what we were thinking about doing and why we liked the asset. And I'd say that on balance, about 25% were very positive on the deal, 50% were neutral, and about 25% were concerned. But there was no substantial pushback. They're a little bit around the edges. Had there been 3 or 4 major clients who really pushed back on the deal, then we very likely wouldn't have done it. And I think what was clear about that engagement is that our clients were comfortable because we were comfortable. And I think that's a great statement about where we are in terms of the relationship that we've got with our clients. The last circle on this slide, opening a new market, is really about our focus in the U.S. And the key to the focus in the U.S. is that the Vice President knows us. We invested in Indiana when he was the governor of Indiana. We said we would upgrade the toll road, which we've done. We've completely resurfaced the entire road, and we've upgraded about 50 bridges. So he knows that we do what we say we're going to do, and we've really pitched this as we can deliver the same thing for the federal program that we've delivered in Indiana. The project that we've got underway is called Project Eagle, and it's a very, very specific game plan around how we think they can open up the market for international and domestic investment. On my metrics, on my estimate, about half of the U.S. Infrastructure market is closed to private sector investment. So opening up that market is an area where we are aligned with this administration. It might be the only area where we're aligned with this administration, but it's certainly one that we would really like to see move forward because it creates a tremendous opportunity for us in the U.S. And then looking forward, the key focus for us over the course of this year is around strategic partnerships. So taking a step back, and the way we look at how we transact is, if we're looking at a deal, the fund will always come first. There's no question about that. The fund will always come first. That's what we do. And the fund can probably take a deal of up to about $3 billion, maybe a little less for the Australian fund. We've done a bit more in the international fund, but as a reasonable rule of thumb, about $3 billion is about right. For deals that are larger than that, we then look at co-investments. And co-investments are an opportunity for some of our larger clients to take a direct economic interest in an asset. And again, as a rough rule of thumb, I think about $1 billion is right. It's going to vary by asset. It's going to vary by region. But we've done it in Port Botany, and we've done it in the Indiana toll road. So nothing about that changes. We promised that we would provide co-investment opportunities, and we will continue to do that. The focus for the strategic partnerships are really in situations where there are larger transactions than that. And what we would have done in the past is built out a consortium. We would have teamed up with a Canadian pension plan or one of the sovereigns to bid together for the asset. The focus on strategic partnerships is to rally a select group of investors who will come into that bucket essentially. They'll allow us to transact, so we will have control over the deal and potentially to manage the assets going forward. The benefit for them is that they get access to much greater deal flow. And the benefit for us is that it gives us a lot more control over how we effectively take out an asset. So that's what we're really focused on over the course of this year. I think we've got some more work to do on the terms and conditions, but given the progress so far, I think that there's the potential to build this out and to really try to drive a continued rate of growth in a slightly different form. Thank you.
Good morning.
Morning. Stand here. We're here to talk about global diversified credit. Good idea. But in the beginning, I'll tell you a bit of history. Specialised Credit Fund was established by IFM in 1999. This was before IFM even had a debt investments team. So Specialised Credit Fund was originally an outsourced model with 5 managers who each brought specialisations of infrastructure assets, structured credit, corporate credit, and eventually over time, as IFM established a debt investments team, all of that was insourced and brought into IFM, which we hold now. So all of those are currently insourced by IFM. So the Specialised Credit Fund has an 18-year track record as a result, which is quite a unique product. It's one of the oldest types in the country, and it consistently outperforms competitors and currently has 1.8 billion in funds under management. It's a cyclically resilient strategy, and part of that is because we can buy bonds, we can buy loans, we can buy public transactions, private transactions, we can go up and down the credit structure in terms of senior, subordinated and mezzanine investments, and across a very diverse range of asset types or industries, including structured finance and also infrastructure debt. So all those things are quite positive. However, there are currently some concerns. The story is relatively unknown outside of the industry fund family, so there's not a lot of marketing, I suppose, being pushed outside of the success of the 18-year history that we do have. We only have 19 clients, and currently with the accumulation stages of our end clients, they're very much focused on growth, and there's not a large allocation to debt, fixed income or credit. So this is the challenge that we do have. Notwithstanding those challenges, Specialised Credit has initiated quite a few new credit strategies, including diversified credit IMAs, where we had two very large of investors in Specialised Credit come out of that fund and create a shadow portfolio. So essentially, we have two large clients who would invest in the same assets as Specialised Credit Fund with the same strategy. We have 2.9 billion at the moment in funds under management for those. One of the other strategies that was introduced was a high yield or an opportunistic strategy. It's a bit smaller in size, but these would invest in sort of double B, single B rated assets where the investor seeks a higher return. One client, again, single exposure, but limited capacity in the market because there's not too many of those types of transactions. Another credit strategy created out of a Specialised Credit Fund is global infra debt. And I'll get Haran to talk to that, given his involvement in that in recent years.
It was the first time the team decided to look at moving into the global investment space. And the way we approached it at that time was to really look at where we as a firm and as a team had a clear competitive advantage in what we deliver, and we could offer a unique investment proposition to investors, not just domestically, but globally. And the way it's worked out over time has been that it has been hugely successful in the global client base space. We've had a significant amount of traction from international investors, particularly insurance companies, coming into the strategy, and we now manage circa 3.5 billion, and we have 11 clients within the strategy from the US, UK, South Korea and Japan. One of the concerns around that product is that although it's been hugely successful, it may be exposed to a little bit of cyclicality. Because it's a narrow focus strategy, once the market turns and shifts and the strategy becomes relatively unattractive, we need to think about what happens next and where does the strategy grow to and expand to. So the solution we're thinking about is how do we replicate what we have with a highly counter-cyclical product, and one that actually operates well through the cycle in the Specialised Credit Fund, and how do we offer that globally? So the first step is, and we're looking at this as a two-step process. So step one is to actually broaden the existing offering of SCF as a fund to a wider client base. That means looking outside the industry clients that dominate the strategy and the client base right now, and expanding it and offering it to other domestic clients, as well as a wide range of international clients who should find that strategy far more attractive. Firstly, not just because of the high level of alpha it generates right now, and has done so over the 18-year track record, but also because they have a natural inclination to invest more in fixed income and credit. We believe that the strategy is globally competitive. It delivers high risk-adjusted returns. We actually take on a lot less risk than most of our other competitors in the global space who operate more in the high yield market than SCF does. And there is capacity available. So right now we're going through a process of making the product ready for a global offering. As a part of that, we're also looking at repeating what we did with the infrastructure debt strategy by spinning off a number of other sub-strategies offered within Specialised Credit Fund to a much wider client base. This has actually been ongoing and up and running for the past 6 months. The most successful of this so far has been our ABS strategy. IFM is actually the largest investor in mezzanine debt when it comes to Australian structured credit and asset-backed securities. We've looked to make better use of our market dominant position in this space and actually start offering it to other clients, and we believe it's particularly attractive to overseas clients because of the high credit quality that's on offer and the high returns relative to everywhere else in the world. So our ABS market actually outperforms the US and Europe by a significant amount, and we're talking about hundreds of basis points in alpha. The other offering we're actually thinking about is property debt, and both of these are actually going to be offered on a very selective basis to a targeted small number of investors. Phase 2, and this is a longer term plan for us, is to actually consider how we replicate SCF on a global basis. Right now we have a unique product that's focused on a single geography that's highly successful. But the actual model that we've implemented in getting that strategy up and running and delivering returns can be replicated globally. We have the skills within the team to do that, and we have the relationships that we can leverage to try and access alternative markets to make the same strategy available on a global basis. So in the near term, we're going through a due diligence process, and it needs to be a very thorough due diligence process by looking at which will be the priority jurisdictions and priority regions that we want to focus on, where we can deliver a product that's highly competitive, but also gives us as a team a competitive advantage over the other large global players. So again, the focus will be on potentially a niche offering or looking at something that we can deliver better, not just on a price basis, but on a return basis as well. The product will be open to both domestic clients as well as international clients. We think the domestic client base is actually very important because there's an increased focus on our domestic clients as they grow bigger to start looking outside of the domestic market in this space. They've always historically compared our SCF product to global high yield credit, even though this has been a somewhat misguided comparison. That's always the way they've looked at it. So our idea is to provide them with an alternative offering from a trusted partner. Thank you.
Thank you. So now we come to the time for questions. Could I ask Brett to moderate? And for those of you who want to ask a question, please put up your hands and we'll pass you a microphone. You have to speak into the microphone for the sake of those who are online. And for those of you who are online, please type in your questions, and we have Rob Lawson who will read them out for us. Rob?
We're running a bit short of time, so fire away on any quick questions now. What I might also suggest, I know we have maybe not last year, the year before, we actually also we sent out some further, blueprints, purple blueprints, let you absorb this discussion, and then there'll no doubt be a range of other questions, and people might want to even table them confidentially. And I remember a year or two ago we had about 12 really good questions that came out, and that seemed to be the preeminent questions. So happy to take questions now, but I'd also suggest that we will set up the opportunity for you to think about it and provide any other further questions down the track, and we'll respond to those. But in the meantime, Sharon.
Is that working? Yep. With the corporate objectives, Brett, product performance, the metrics, are they reduced for this year? And if so, why?
Yeah, so reduced is yes is the bottom line, and I sort of tried to explain that what we do is we try and arithmetically assess where we are, what's the rolling 4 years for each and every one of the products and mandates that we're measuring. Where does that put us against the client objectives after fees, after taxes? What would we need to do this next 12 months in order to ensure that the 5 years, the 4 that we've already done, right, they're done and dusted, they're in the bag. What would we need to do this year in order to get the rolling 5 years ahead of the client objectives? Some products and mandates, you'd sit there and say, we'd have to do some extraordinary things. We'd have to take some extraordinary risk to get the return in the 1 year period to get the 5 year over the line. So we've been practical and pragmatic about the likelihood of that. There's stretch in that, but we don't want, you know, an asset class that's got an objective of X to have to do 3X or 2X, you know, in a year in order to get the 5 years ahead of the game, because that wouldn't be a good long-term outcome for the clients. Now, clearly there's, you know, we're not just turning up and, you know, doing our job. There's value that we have to add, but we've been quite arithmetic and I think sensible in making sure that the objectives we've set are, you know, consistent with the 4 year track record that we're inheriting. Not inheriting, that we've achieved. Duncan?
Just a question for Kyle. You mentioned the growth in both funds, you know, sort of averaging 30% in the size of the funds. And obviously the strategic partnership stuff is looking to keep going after big deals and getting everyone sort of in our tent. Is there a place where the fund is at its maximum? Like, is there a $50 billion fund out there that means we need to start looking at another fund, or, you know, what's the view on that?
Look, I think in terms of looking at another fund, that's work that we're doing in parallel as well, on the basis that there's a part of the market that we've got insight into, but we don't really target, which is the higher risk spectrum. These are good assets, they're good deals, but they just don't fit into a core fund. So that's going on in parallel. In terms of your base question about the size of the fund, we've done a lot of work trying to find anything empirical on that, and there's really no data. There's nothing in an academic sense that says this is the right size for an open-ended fund. And we looked across the real estate spectrum. It doesn't really exist at this stage. So the work that Michael Landman has done is to really evaluate, you know, what point does the fund no longer benefit from incremental diversity? When do you get to that sort of point of diminishing marginal returns? And coupled with that, when do we have a fund where we can sell an asset and not give away the benefit of diversity, right? Because you want to have as diversified a portfolio as possible, and we estimate that to be around sort of 25 to 30 billion, but it's probably a little bit broader than that when you put in a regional overlay, which is the work that we're doing this year. It's not perfect, but that's about the best estimate that we can come up with in terms of not really having a driver behind adding to the existing fund.
All right, we're 5 minutes over time. I apologise we haven't left enough time for questions, but as I said, we'll set up a opportunity for you to perhaps in writing share those questions, and then we'll get everybody together over a drink. Why not have an excuse for another drink in Club 29, where we'll, you know, the top 10 questions that seem to be preeminent based on the plan that's just been discussed have come out, and we'll seek to answer those questions in another forum in a few weeks' time. Again, thank you for all that's been done over the 20 plus years, and some of you have been here for, you know, a very, very long period of time, and, you know, have really married up, you know, a truly unique model with a world-class team delivering some outstanding results across the board. So thank you for all that you do all day, every day in making a great model a truly wonderful investment management business. The plan remains unchanged in terms of the longer term aspiration. It has served us well. We don't want to change it just for the sake of it. The 5 goals that we've got have served us well. We want to continue the focus. Our cultural foundations are critically important. We have not discussed them today. They remain unchanged and very much in our DNA, and something that we'll continue to focus on. But the metrics have changed slightly, and we've got half a dozen or so initiatives that we think, above and beyond all the stuff that we're doing all day, every day, we will continue to do more of and even better through the course of this year, through the collective core funds, the expansion of the infrastructure equity, the debt, etc., etc. So thank you for all that's been achieved. I hope you found today clear. Hopefully it's compelling. And where there are questions, we will seek to get those and otherwise answer them in another forum. But thank you again for taking the time out, and we look forward to another wonderful year in this great history of IFM, and to continuing to really serve investors well and create that prosperity internationally for the underlying investors and for the countries and communities in which we invest. Thank you. Enjoy the day. Enjoy the year. Thanks again.